Hello everyone. In this video we are answering a very important question that I got from multiple of you. And I think it's a very smart question. And that question is, how high is too high for Tesla stock to jump on the train or jump off the train? When is it time to do that? This is a very important question because Tesla stock went to the moon, say some, since the election less than 2 months ago. Tesla stock went from 260 to 500, nearly 500, and it's breaking through very likely. So some people think, oh, that's crazy. It's going to go 100% up in less than 2 months. I can't jump on that train. I'm sure it's going to drop. Other people say, no, as long as it's under $1 billion, you have to buy it because there is no end in sight. It's going through the moon and then it's going to Mars. What do we do about all these statements? And what do we do to answer the question rationally and quantitatively whether you should jump on board or not? And as always, this is not investment advice. Do your own research, yada. I'm just sharing some models here and share with you what I'm thinking so you can make up your own mind. So I prepared, of course, a little model that we can take a closer look at to answer this mother of all questions. How much is too much? And what exactly should I do depending on the stock price of Tesla? So here we have the model. And let me explain how this model works. It's a very simple model, so I'm not going to talk too much about it. I just want to share how you answer questions quantitatively and not just qualitatively. It's not enough to say, oh, Tesla is the most amazing company on the face of the earth, because everything has its fair price. And even the most amazing company at some point is overvalued. And even a crappy company at some point is undervalued. We can't say if Tesla is amazing or not. We have to understand how to quantify and put things into a relation. Okay, here is the model we are going to look at. And it's a very simple model in a way. Let me zoom in a little bit more. What I did here, I created a model where you have a beginning share price, and let's assume that is at any point when you are looking at the stock. It could be now, but let's assume you're doing this in 2025, like in a couple of weeks, and you can enter your stock price here. How does this model work? You enter the stock price, for example, $500. Let's just do it 500 for fun, because that's close where we are now. And then you have 2030, the target price. Now, this target price, of course, is something you need to decide on your own. But I did my analysis. I mean, there's a whole model here that we are not going to go into right now. You can check out the old video on it. There will be an update video, hopefully in December, on the latest changes to that number and the risk inputs and everything. But my conviction is this is the most conservative number I can come up with right now. Tesla stock will be at 10,970 in 2030. Now, I can be wrong by 50 or 100% because next year it would be much higher. So we might end up at 5,900 or 20,000. That depends how we pull forward things. But roughly 10,000. So at 10,500, first of all, you look at your multiple, right? That's it. Very easy math. 20.9x. That's how much you make. That means if you put in $100,000, right, and you go 100% into Tesla, based on this model, if this price comes to fruition, you will have $2.1 million, right? You put in 100,000, 2.1 million. Now, maybe you're rich. Maybe you have $1 million, right? Oops. Maybe you have $1 million. And you can see what happens then. Well, and then you make 21 million. That is great. Now, why is this important? We also see the core CAGR. So in case you don't know what CAGR means, it's compound annual growth rate. Basically, this number here, that is your CAGR, tells you how much return you make per year. And again, this is a function of the beginning share price and your end target share price. That's why it's so important to have good models that predict the share price accurately. I think my model is probably the best to do that because it recognizes future revenue streams. It discounts them systematically by the risk we attach to them. This is a very conservative model, so I'm very likely wrong on the downside. There's more upside to this, but it's better to be conservative here. If I'm wrong, right, and you make more than 85%, no one is going to blame me. So how do we deal with this model now? Well, we are saying you are asking this very important question. What happens if the share price is higher, right? So let's think, you think Tesla is going to drop. You're sitting on the sidelines. But guess what? Tesla is going to go to 800 by January, let's say, hypothetically. What happens then? Well, as you can see, your CAGR, your annual return over the next 5 years, goes down to 69%. So at 500, you're at 85% per year that you make. At 800, if you wait and go in at 800, assuming that happens at the same point in time in 2025, you make 69%. Why is this so important to play with these numbers? Because it tells you something. If Tesla's at 500 now, it goes to 1,000 while you're sitting on the sidelines. And you think, damn, now I really missed the train. I thought it's bad when it went up to 500. Now it went up to 1,000. But if these models that we are hearing from me and many other analysts who actually understand Tesla, they're all gravitating now towards my number, by the way. It's interesting. More and more people come out of the woodwork and say it's 10,000. If that is true, and all facts point to it being very likely true or conservative, even at $1,000 share price right now, you would make 61% per year. So this is a very rational way of approaching things, because you have to think about your reference, your benchmark return. If you wouldn't put money into Tesla, where else would you put it? And how much money would you make there? Let's assume you put it in government bonds and 30 or 10-year treasury bonds and leverage them a little bit. So let's say you make 12% or something a year. Well, what does it mean? First of all, can you even leverage like that? But let's say you have 12%. Well, then as a rational investor, if you say your alternative benchmark is 12%, you would stop investing in Tesla at the share price that generates an annual return over the next 5 years that is below your benchmark. So let's assume your benchmark is 12%. That's the rate you expect to make every year on your investments. How high does Tesla have to go next year in 2025, assuming the 2030 target share price is correct? How high does it need to go in order to generate only 12% a year? Well, let's test it out. What if it goes to 5,000, which I'm pretty sure it won't, but let's assume it goes to 1,000 next year. You still make 17% per year over the next 5 years. That is a very important insight. If Tesla, the stock, 10x's goes up 1,000%, let's say in the next 6 months, it is still one of the best investments you can make. Think about that. I'm not saying invest in Tesla. Do your own research. This is all dependent on the number in 2030, and I'm right about it. But I tell you, I'm highly convinced I'm at least right, if not below what it's going to be. And what do we take away from that little game we are playing here? Let's say it's 6,000. Then you're at 13%. You're still above 12. I made up the 12%, by the way. You have to figure out what your benchmark return is. You do that by looking at your portfolio, let's say over the last 5 years, and see how much you made per year in average. Make your average correct, right? So, and then you see what your benchmark return is, and you should aim at finding investments that make you more than your benchmark return. So at $6,000 share price in 2025, it's important. We are only talking about 2025, otherwise the model changes. You're still above 12%. So in other words, because Tesla is such a transformative company with enormous upside potential, there is practically no share price in the short term that is too high to jump in, for me at least. I mean, I wouldn't buy this at, let's say $3,000 next year. I would make 30% a year. I'm not very happy with 30% a year. I want to make much, much more than that. So at 3,000 in 2025, I would get a little, less appetized by Tesla. But I mean, at 500, you're talking about crazy returns. And you can put in any number here you want. Let's assume you have $200,000, right? You can quickly simulate at that return at $500. If that price comes to fruition, you're making $4.387 million, which is pretty good. Now, to wrap this model up, just for fun, maybe you have wondered what that little line is down here, my alpha line. So that line basically describes, it's more from my personal perspective, what is the relative alpha I want to generate? So relative alpha means in percentage terms, how much more percent do I want to generate than a core position Tesla? That's what we discussed in the previous video. If you want to generate, let's say, a 2x leverage or better x alpha, that's very different from leverage because you always win with alpha in theory. So at 100%, it means you're making basically twice as much as this. 100% alpha, right? That means this is the money you make on this whole thing. And in this case, your multiple would be 144 times. So with $200,000 invested, you come out at $30 million bucks. And, that's very interesting. Of course, if you get in a little later at 600, it goes down. But this alpha exercise here tells you why it's so interesting to actually put in all the effort to do active alpha trading on Tesla. Because if you succeed, even if you only generate 50%, which, it's very possible, you see the differential here between having 100% invested in Tesla and generating 50% alpha above that. The difference over 5 years is instead of 3.6 million, you're ending up with 9.8 million at 50% alpha. And so the question you have to ask with all the stress and all the options and all the watching, the trading and stuff, is it worth, generating, roughly $6 million more over 5 years? Probably, especially if this number is higher, right? So this tells you that at some point it's worth to learn the trade of the trade. If you have $1 million in the beginning and you generate 50% alpha over 5 years, in the Tesla case, instead of making 18 million bucks, you're making 50 million. That's a very big difference, and that's worth doing a little bit of trading. So that's just for fun, little side note. I hope you enjoyed that model. I think the big takeaway here is when people say, oh, is it too high? Is it too low? Is it still worth going into? One thing that I find very important with stocks and investing is don't respond to quantitative questions with qualitative answers. Don't say, oh, is it worth it? And you say, yeah, Tesla is great. That's the wrong dimension to answer a quantitative question. You should answer quantitative questions with quantitative answers and say, well, what is exactly too high? What is too low? For that, you need the current stock price. You need a target price. You need to compute your CAGR, and you have to compute your benchmark, and you can play around with the money you put in, and then you have a good model. And then you can answer the question very simply, is it too high or not? So I hope that was helpful. Tune in every Monday for some Tesla trading week predictions. And I hope you enjoyed that, and to see you very, very soon so we can talk more about Tesla, the stock, Optimus, and a great future.